Okay, so Darren, walk me through the different types of debt products that you were mentioning just a moment ago.
Yeah. So common debt products usually have a yield or a return annualized out between 8 and 12%. I would tell you most of the time on average, you're looking at close to a 10% yield, right? And that's the common industry standard with debt. And I think that is a good return. If you're looking more on the private equity side of things, you'll probably more commonly see a 15 to 18% return or yield, right, on the capital that you participate with or you lend out, right? And that ultimately those differences in yield is really the risk, right? Like the higher yields means there's a higher risk, right? And we kind of see this commonly within Gator, right? Gator happens to be a high risk, high return, right? So you have more closer to like, a 50-50 in Gator that if you put it in, you might get it out, right? It might work, it might not work, right? The returns are just astronomical, right? And private equity, same thing, right? A little bit less, right, risk, but still like a moderate type of a risk return, right? And that's why you see that 15, 18% returns. And then debt happens to be the less risky, right? Because most debt products, right, have quite a bit of security around it, meaning they have security around assets, right? Personal guarantees, things of that sort. And when they're in a debt product, right, because they're a little bit more of a safer or less risky, they have a lower return, right?